thank you all for kind of joining in, having that leap of faith in terms of understanding what we are to offer. And I hope you guys enjoy the session today. The series will be followed by two of our experts, Pooja and Dhananjay. Pooja, part of InCorp, Dhananjay, who's part of DBS Bank. And I'll give you a quick introduction of the people who are there on the call today. We have Pooja Dedhia. She's a qualified chartered accountant in the year of 2019. She's pursued her Bachelor's of Accounting and Finance from HR College and Economics in Mumbai University. She has also obtained a diploma degree in international taxation from the Institute of Chartered Accountants in India. She currently works as a manager at InCorp Advisory Services Private Limited. Her area of practice primarily includes FEMA, direct tax, domestic as well as international advisory, compliances, and litigation. She's currently handling advisory and compliance related matters under several statutes in India for various Indian subsidiaries having parent entities listed on NASDAQ as well as on NYSE. We also have Dhananjay Pendse. Dhananjay primarily has started his banking career with Bank of Baroda in 2000 in branch banking, subsequently moved to HDFC, handling trade, finance, local and foreign operations. He then has handled capital account advisory, reporting desk for Mumbai region, and headed the RBI licensing desk and acted as a nodal officer for HDFC, working very, very closely with the FED department of RBI and compliance team of HDFC. Dhananjay has been with DBS since 2018. He is the head of cash for cross-border operations, handling A2 and inward remittances, and now heads a dedicated unit for advising, handling capital account transactions on various complex structures and handholding capital accounts for capital account cases. So I think you've got the absolutely right people on this call to kind of address most of your queries, both having immense experience in all FEMA related matters. And so without much ado and without wasting too much time, I will, hand the conversation over to our experts. One small thing, request everyone, while we've done our needful of keeping everyone on mute, uh, request everyone to post your queries in the chat box. We will take queries and questions to the end of the session once the session is over. If there are any queries or questions which are left or not answered due to paucity of time, rest assured our team will write back to you through an email. So we'll try and address as many questions as we can. But if there's anything that remains, we will write back to you on an email. You can be rest assured on that. So use the chat box. Please feel free to ask any questions, and we'll try and pick out some of the most important ones. Over to you, Dhananjay and Pooja.
Shashank, thank you so much, Shashank, for giving such a good description and setting the context of today's webinar. So starting with the webinar, giving a brief about why exactly ODI is required and what exactly are the regulations and how does the business models work along with it. And since the remittances and all the transactions have been routed through the bank, it is important that we understand the regulations when it comes to bankers from the bankers perspective as well. So in the initial like 90s 70s, the trend was that there were many MNCs which were located outside India and who had the base outside India, and they would want to invest in India and start with their markets in India, and will want to have an investment in India to explore the resources and resources of India. So now the trend has changed. There are various MNCs which are based out of India and who are planning or who have already used or explored the overseas market, so as to expand the business or to diversify the business or to use the best resources which are available to them from outside India. So from the business perspective, they want to grow, but as it is important that all such transactions are also being taken care and overlooked by any regulatory authorities. Since it is relating to an overseas transaction, obviously RBI is the authority who looks after it, and taking transactions in foreign currency, FEMA comes into place. Now, since the transactions are made in foreign currency, obviously it goes through the AD bank, and I think Dhananjay is the best person to give a background about how the transactions, when how such overseas direct investment transactions, when it comes to bankers' perspective, have been taken care by them.
Hi Pooja, hi Sushant. Thank you for giving a brief intro, and thank you Pooja to taking us through from an industry perspective. But as we come to banking, and as you rightly pointed out, in the 70s and the 80s, when the regulations were more on the regulatory aspect, that is FERA, the FERA era and the FEMA era, famously, and come 2000, and here we are into an area of operations where RBI wants to manage the foreign exchange and liberalize to the extent possible. India being a capital deficit country, as well as having their own issues with managing the foreign exchange, and especially on the balance of payment scenario. Uh, 22 years since its inception, I believe RBI has come a long way from liberalizing the overseas investment space, as well as allowing many things into more as an automatic route rather than going to RBI for each and every stage. And I think we are going to learn today something on how shall we make a breakthrough in this particular area of investments or area of foreign exchange, I would say.
Thank you, Dhananjay, for the brief. So could you share your views on who exactly are the individuals or the entities who are allowed as per FEMA and RBI regulations right now to make overseas direct investment, and once like the set of individuals and the entities who are allowed, what are the modes via which they can make the investment?
Sure. So let me brief everyone on two aspects. One is who can invest. That is the first important question what anybody wants to ask as a layman. So investment under RBI's FEMA ODI regulations is permitted to be made by an companies incorporated under a Companies Act I mean incorporated in erstwhile 1956 or in 2013. A registered partnership firm, LLP, a body corporate defined by Parliament, or an entity recognized by RBI. So these are few entities who constitute something called an Indian party, which is defined under ODI regulations. And Indian parties are an entities who are allowed to remit or make investments abroad. In 2013 March, RBI has also extended this particular what do you call provision, or this particular facility of making investments to resident individuals, especially the HNIs, or people having sufficient technical know-how to manage and run the business abroad. Those individuals are also permitted in from the year 2013. I mean, they are defined as resident individuals basis a law, and the limits which they can accrue or they can make remittances are restricted to $250,000. That is or the LRS limit, whichever is applicable for that particular era. Coming down to, since I explained the resident individual limits, which is restricted to $250,000, naturally the question asked is IP or an Indian party. What are the limits applicable to make an investment by each Indian party? So RBI has kept it very simple. For your 400% of your net worth of the last audited balance sheet, an Indian party can make an investments abroad. Overall investment limit in a financial year is capped at 1 billion per year, and subject to, I mean, it's not restricted. The company wants to invest above 1 billion USD or equivalent can come to RBI, seek specific approval, make a business can, and I've seen in my last 10 years of licensing with RBI, they do approve such kind of cases. Making modes of investments are various. You can say and company can make an investment by subscribing to the memorandum of the overseas entity, that is an actual share allotment, or contributing to the capital of the company, or purchasing those shares from an existing shareholder, or the last part is by an individual or who is granted an ESOP by an overseas entity. Even that is an acceptable mode of investment. So coming back to you, can you also share, Pooja, what are the permissible routes of investments and what are the restrictions on sources of funding coming from an industry perspective or your line of activity?
Surely,
Can you
then.
throw some light? Yeah.
Surely. So when it comes to let's like once we understand the definition, like who are all are allowed to make remittances, I think the next concept what we need to understand is first the concept of JV and wholly owned subsidiary. So a resident individual or an Indian party, whoever wants to make investment outside India, can either have a entire 100% holding being held by them. So in that case, such type of entities will be considered as a wholly owned subsidiary of the Indian party or the resident individual. Now the second part is like that because of the advent and of technology today, it is such that there are joint ventures or say Indian party as well as some other third party, be it resident in India or outside India, would want to get into a joint venture and then incorporate a company in outside India and then proceed with their investment and using the resources over there. So such type of investments where the Indian party or the resident individuals do not hold 100% of the capital of the overseas entity, such investments will be considered as joint venture. So
So,
understanding, yeah.
Pooja, one question. Sorry to stop you. One question for everybody's benefit. So, if there are multiple parties investing from India, will that consider as a WAS or a JV?
It will be considered as JV and not was. So if it is purely one person investing outside India, then it's a was. If it is multiple parties, be it even in India, like one resident individual and the other Indian parties, or say multiple Indian parties also, it will still be considered as joint venture.
Okay, thank you. Yeah, you
Okay.
may proceed.
Yeah. So after understanding the concept of joint venture and wholly owned subsidiary, which is was, the next thing is how will the remittance be made from India and what are the modes of investing? So modes of funding, especially like you give
Exactly.
us the background that the amount is restricted to $250 in case of resident individuals, and when it comes to a Indian party, the limit is restricted to 400% of the net worth. So for funding the 400% of the net worth, Indian parties or the resident individuals can firstly either use the funds which are available in their EEFC bank account, or secondly they can use they can draw foreign exchange from the AD banks, or the third option is that they can be allotted bonus shares directly, in which there is no remittance as such required from the Indian party. They can use the proceeds of ECB, the external commercial borrowings, or the FCCB's amount which can be used, and then there are funding ways in which they can even swap the equity shares, swap shares, and fund the investment outside India. So one point of consideration here is like when you do all the like say withdrawal of foreign currency from the AD bank, or say it swap of shares, or taking EEFC bank, or using proceeds from ECB and everything, all such things have been covered in the cap of 400%. But if you use amount which is available in your EEFC bank account, that will not be considered as a part of your 400% of net worth. So say for example, if some person wants to, or say some entity wants to make an investment using the balance which is available in EEFC account also, and since we have the cap of 1 billion USD, I think up to 1 billion can be taken care of by using the drawal, and the balance over and above that can be used by EEFC bank account, so that the entity does not have to go ahead with the approval route as such. Okay,
Okay.
and then now giving like what are the activities like which are permissible to be permissible for investment by the Indian party and the resident individuals. So this have been actually divided into three parts. First one is the approval route, where RBI generally has given a general permission to resident individuals as well as Indian parties to to have their investments outside India under general route, which is already allowed. So activities which do not fall in the second and third category are the ones which fall in the first category, and they are allowed under automatic rule. Now coming to the second part is where RBI will want to monitor the investments, and in such case they allow investments, but the investment goes under approval rules. Like say for example, if it is a if the Indian party wants to open a banking company outside India or an investment making company outside India, or say be it a real estate industry outside India, if the Indian parties want to invest in, then first they will have to take approval from the regulatory authorities in India, and once they receive the approval from India, then they can proceed with the investment outside India. So this is about the second thing. Like say we can even cover the instance of where the investment outside India is over and above the cap of USD 1 billion. Again, it goes at approval route, be it even if the investment amount is within the 400% net worth. Now the next thing can be like investment if Indian companies will want to make investment in say Pakistan also. Again, it is allowed, but it is allowed under approval. So first, once the approval is taken from the regulatory, they can go ahead with the investment. And the third type is the prohibited activities, where government will not want Indian parties to be investing outside India. Such type of sectors, like even under approval route, are not allowed. So to conclude, like if we are if so if in a good way, if you want to say, if your activity does not fall in the second thing, which is the approval route, or if it does not fall under the prohibited activities route, I think all other type of activities will fall under the automatic route. Dhananjay, could you just give us a brief about like how does the approval route work when it comes to bankers? So because the regulation says that the Indian parties, they will first have to approach the AD bank, and then the AD bank takes up with the RBI. So could you just share your experience in such cases?
Okay, first I will then take you all through a concept of AD Bank. That is an authorized dealer bank, which is very important to everyone to understand. So any entity making an investment has to route their investments or remittances only through their one bank. Whenever a transaction is first transaction is made through a bank, that bank will first have to report this investment to RBI in the online OID portal and generate a UIN, that is a unique identification number, which has to be used for all future references and reporting to be done by that investing entity in India. It may be an individual or it may be an IP, or a company, whosoever is investing abroad. Coming back to the approval route scenario, approval routes are there whenever a client is not meeting the preconditions prescribed by RBI for making an investment abroad. Uh, just to give you an example, for example, client is not meeting a 400% net worth. A client is not reported the APRs. That is an annual performance report, which is an obligation to report, and still client want to make an investment abroad. Uh, just two prime examples which most of the cases are received. Or if an company who wants to invest into a financial sector, uh, most likely in the countries like, or in the geographies like Singapore or US, where certain activities are does not require prior approval of their regulatory bodies, like in foreign Singapore and MAS, which regulates the financial sector in Singapore, has liberalized, say, an advisory services by an investment advisor, where they don't require no, a clear approval from MAS to conduct the businesses there. However, in India, SEBI warrants everything under approval route, and an entity carrying out an investment advisory services will have to approach SEBI and take a specific approval. So there are conditions which requires both entities should have an approval in place before an entity makes an investment into a financial advisory sector. So if that condition of mass is not meeting, because technically there is no approval required, even for such cases we might have to approach RBI and seek the specific approval. So generally an application is made through an AD bank, and the applications are sent to FED OID division of fifth floor Amar building, which is the nodal office at RBI, where all centralized applications are received and scrutinized by RBI, and then given approval or given their rejections basis the merits of the case. So this is then overview on how an approval cases work. So most important point what we advise our clients whenever they come to us to seek an approval is what is the economic sense and business justification they have for RBI to consider the case favorably. Dealing with RBI for so long, I will just once say a point. RBI do consider business logic and business sense to
Genuine
make
cases.
genuine case and give an approval. That has to be very strong. There should not be any loopholes in that. Else RBI won't approve, or they are not obliged to approve in such cases. So that is one factor which everybody wants to know whenever we make an application to RBI. Yeah.
I think it makes sense also, like if it is like regulated activities as such, where RBI will want to have a close look. Going under
Yep.
approval route makes sense so that at least RBI understands what exactly is the requirement of the business. And as such, there are many cases where they will want to shift their funds from India to outside India, and then they would like to just have an entity or have an entity outside India. So such cases ideally usually should go under approval route, understandable.
Yeah.
Dhananjay, could you also give us like, is it permissible, like once the wholly owned subsidiary or a joint venture is incorporated outside India, is it possible for those entities to further invest in other geographies, or is it possible to for such entities to further expand, and what are the regulations if it is permissible when it comes to FEMA? Can you please give a brief about it?
So there is no restriction for to make an further investment by a JV was of an Indian company to further step down subsidiary, either wholly owned or partially owned, as long as the investment activity or the activity of the overseas step down subsidiary is bona fide and does not breach the FEMA regulations here. Assuming if that entity is engaged in an activity which is prohibited under India, like in real estate activity, which
Right.
is which falls under the prohibited sector, and
Mm.
if that entity is into that activity, then it is a prohibited activity, and JV was abroad cannot invest at all. Okay. Uh, there are entities right now or large corporates in India who are having multi-layered structures, or you can say a web-like structures wherein they have got investments. So they have got subsidiaries and step-down subsidiaries into multiple regions. They are cross-holding their investments. Uh, uh, RBI has not come out anything which prohibits such kind of structures. So they are very complex and very web-like structures. Possibly entities have got into it to have their because it makes business sense to them to have such structures abroad. Uh, However, RBI says parts as 2 points. One is the activity has to be bona fide, and second most important aspect is the reporting requirement. Whenever an investment such downstream investment has been made by the wholly owned subsidiary into another company outside India, that has to be reported back to the RBI through its ready bank within 30 days. That
Okay.
is nothing but, if you ask me in an operational term, we call it reporting of step down subsidiaries. So there can be an first level step down subsidiary, second level step down subsidiary. It doesn't matter as long as the reporting is done and the activity is bona fide.
Understood.
Third point wanted to add, you may have queries, or we may see a lot of structures nowadays wherein an investment is coming back into India, which is not a permitted activity as per the definition of ODI. If you ask me,
The
the legal
FDI
aspect of it,
ODI structure.
yeah. So this structure is not approved by RBI, and it has to be, I mean, not under automatic route definitely of RBI. It has to be referred to RBI on case to case basis, and again, as I said, you make a business case out of it.
Agreed,
That
agreed.
is the most
So
important aspect.
Right. So then I think just to add on this thing, on your last thoughts, like the FDI, ODI transactions, what are not routed through. So in business parlance, they will say this structure as a round tripping structure wherein investment is made from India to in an overseas entity, and then again it is being brought back to India by way of that subsidiary having a step down subsidiary again in India. So such type of
Yes.
structure is what RBI usually, I think, does not entertain, or they will not want such structures to be incorporated in India, and therefore it makes sense for them to go under the approval code. Dhananjay, could you share your thoughts? Like, is it permissible for resident individuals who have overseas, who has wholly owned subsidiary or JV outside India, can they further have step down subsidiaries, or is it permissible or it's not permissible?
You're talking about resident individuals
Yes,
investing abroad.
yes, yes, yes.
Okay. So resident individuals also have the same set of rules. The rules do not change just because they are resident individuals. In fact, resident individuals can only invest into equity. They cannot invest as a loan. So an individual cannot give loan uh, to its own subsidiary. The investment has to be by way of loan only, by equity only. Further, they are not allowed to invest further down by way of a step down subsidiary. So these two main provisions are there, which restricts individuals up to an extent.
Agreed. So then I think if it will be better if the planning of the business sectors are such that if they want to invest outside India and really want to grow outside India, it's better if they go via
See, you
Indian
you should
party route.
see, you should understand this route of investment is not to hoard money outside India. Okay, this is for bona fide businesses.
Right, right, right.
Uh, okay, you cannot just have a structure in place. I mean, as an AD bank, if an newly formed company is there and if doesn't have any business prior to it, I will ask relevant questions. Why they want to make an investment into a company in which they don't have an experience in India? You can
Right.
create papers here by having an audit done by way of only capital contribution of an Indian company. But as an AD, it also becomes our responsibility to ensure this money which is going is used for bona fide purposes.
Right,
So
right,
this is
right.
one question even RBI asks,
AD
why you
members.
think it is justifiable for you to approve a case. So
Hmm.
that is also a large ownership which AD has it.
Understand, understand.
Yeah. So coming back to our main agenda. When it comes to JV and WAS, there are certain regulations which Indian party must keep in mind. So, do you can you just take us through the reporting individual or rather reporting requirements for an individual as well as an Indian party, or I mean, on obtaining UIN, what are the various mandatory reg reporting done to RBI or any other entity for that matter?
Okay, surely, Dhananjay. So, giving a brief about the reporting procedure, let's start with the first set of things. Like the first time when an investment is made outside India, the first thing is that first they will approach the AD bank. They will have to obtain a unique identification number, or the UIN, which has been commonly known as. And based on that UIN, all further investments have been routed through. So, like say for example, first investment we obtain UIN, and then the second investment, what we have to do, we have to route it via the same UIN. So the Indian party does not have to obtain a fresh set of UIN for the second investment, is as such what I'm telling. So for the first process to obtain UIN, will the entity resident in the Indian party will have to file Form ODI Part 1, The second thing, the second form is Form ODI Part 2, which is also known as Annual Performance Report, the Form APR, what we commonly call it as. So, Form APR is an annual form which is to be filed by every Indian party or resident individuals, or I would say any entity who has obtained an unique identification number. The third part is the Form ODI Part 3, which is required to be filled only in case of disinvestment. So once an investment is made by an Indian party or resident individuals, it is possible that they will want to disinvest the investment what has been made, or they will want to transfer the entire holding to someone else for the benefit of the business, or whatever the business requirement is as such. So in such cases, Indian parties or the resident individuals will have to file Form ODI Part 3. Now coming back to Form ODI Part 1, so once an investment is made, there are various changes which take place. Like for example, Indian party will further want to diversify and will want to open a step down subsidiary, or else they will like out of they will from becoming a from being a wholly owned subsidiary, they will want to diversify and sell off their shares to someone else like 40%, and they will want to reduce their stake as such and everything. Then like depending upon how the business works out, they will have to report all these changes also to the AD bank, and then therefore for that they will have to file Form ODI Part 1, not the entire form but relevant parts of the form, like if it is changed in net worth, or say further step down subsidiary which has been made, all such forms. And again, now when it comes to filing Form ODI Part 1, it has 5 sections in it. The fifth section is the CA certification, what has been required. CA certification is compulsory when it comes to Indian parties, but when it comes to resident individual, a normal certification from the individual making the remittance also works out.
Self-certification.
Yeah, self-certification is also works out, and it makes sense because that if an Indian party whose books of accounts have been audited is making further investment, the reliability of the document will further increase if it has been certified and verified by an independent chartered accountant, or say the statutory auditor of the company. And therefore, section E certification is required in such cases. Coming to APR now, when APR has been filed, so it's an annual compliance which is to be filled, and the due date of which is 31st December. Again, it has to be given filed with the AD bank, and it has to be on the basis of audited financial statements. So Indian party should have their financial statements audited. Coming to the overseas entity, if the regulations of such entity require them to audit the financial statements, they will have to be audited. If it does not require them to audit it, it's okay, no, not compulsorily required. And for the for the resident individuals, again, it's the same process. They did not have the overseas entity audited if the regulations does not permit them to get the accounts audited. Coming to Part 3 of ODI, which is required in case of disinvestments. This form is required to be filed within 30 days from the date of such transactions, and again, not required compulsorily sorry, as in I would say it is required compulsorily to be filed when the entire stake is been liquidated. So say for example, if from becoming of 100%, if the stake comes down to 30% or 40% or 80%, in such case, the even then it is a disinvestment, it will not be considered as a complete disinvestment, and in such cases Form ODI Part 3 is not required to be filed. The other important filing requirement is filing of form for FLA, known as Foreign Liabilities and Assets, the due date of which is 15 July, and it has a separate portal for the filing. So this filing does not go via AD Bank, it's a separate portal via which the filing is to be done, and it is to be done directly with RBI. Due date of this is 15 July. So at instances like, because FLA is something different from Form ODI, we have seen instances where people have actually forgotten to file Form FLA, and I will say them to rectify it as soon as possible. Or else the thing is that once if it is not rectified, or if the offense become grave enough, then the Indian party or resident individuals will also have to apply for compounding with RBI, which again is a time consuming process and will take almost 6 months to get an order as such. The other, apart from the regulatory, the filing requirement, there are other requirements as well, which an entity would have to comply with. Like say, for example, getting the trade receivables within 60 days, or getting the dividend repatriation back to India within 60 days, and as such, various regulations, because the government of India will want whatever is been receivable is been brought back to India and not been held outside India. So the timeline what they have given is the 60 days
60
timeline.
days.
The other thing is that for the share certificate. So obviously, once you are making an investment, you tell the AD bank, or you agree the AD bank that the amount what I'm making remittance against is the share capital what I'm making against. But then to hold to that investment, the share certificate is really required, so that the Indian party has a right over the investment what it has made. So again, RBI gives time of 6 months to Indian parties and resident individuals to gives back such to give a copy of such share certificates to the AD bank for
AD
just
bank,
for
yes,
record, just for records, but
yes,
it's
yeah, I record. It's just proof of investment, nothing but
yeah,
proof of
yeah,
investment in
so,
equity shares. Yeah.
right. And the other important thing which is required when it comes to the entire overseas direct investment as such, I will want to say that the Indian party or the resident individual should not be under investigation of say ED or as such, because if it is under investigation, I will say RBI does not look into it in a good way. They will want to get into the
So Pooja, basically the one of the preconditions for making an investment is the Indian party or the resident individual should not be into the should not be under the purview of any investigation agency.
right.
Even yeah, for and such cases are referred to RBI to seek specific approval for making an investment. So this is, as you rightly said, ki RBI may not look at it positively because an Indian party being into a uh, under investigation by a Department of Enforcement Directorate or income tax or any such body.
Right, agreed. So Dhananjay, I would like to conclude the webinar. Just
Uh, before yeah,
yeah.
before we do that, can we just answer the questions here, or for everybody's
Yeah.
benefit, we can take few. I think we've got sufficient time. Just a moment. Yeah. Okay. Yeah, I think somebody has mentioned when an Indian party established a WAS on overseas in 2017. I'm just reading out for everybody's benefit. He was within the 400% of the net worth. However, in 2018-19, due to losses incurred by IP, 400% limit was breached, and limit via vis-a-vis net worth. Not, it's very slow. Yeah, sorry, just goes away. Yeah, overshoot by 500 to 550% net. Is there any actionable from the AD Bank or IP to report this RBI, and what is actionable? So as we rightly pointed out earlier in our introduction, the Indian party may not be able to invest further under automatic route. If they are not meeting the net worth criteria, then it will go under approval route. Basically, it will again it will all depend on what is the business sense, and source of funding. The Indian party will inform RBI basis that the decision will be taken. Otherwise, there is no action, but there will be no further investments allowed for that particular entity. I think that addressed. Uh,
I'll
So,
take up the
so Dhananjay,
question.
so Dhananjay and Pooja, I think before we move to Q&A, I think there's one question which I would want both of you to answer from our perspective. With the change
yeah.
in the advent of technology, how do you think the regulatory process is going to innovate, and how do you think there are new age methods that can be incorporated in the system? That's something which I want to have your views on.
Surely, Dhananjay, I'll go first and then you share your
Sure.
views on it. So, Naman, I will say with the change in technology, I will say we will like to see this question in two parts. The first is the business parlance, what is actually happening in the industry right now, and the second thing is the regulatory front and the banking front when it comes to. So, at present, if we see the Indian economy, the growth in the business sectors, or as such, we will say are changing so fast as in like if you see 5 years back there was no digitalization, or the digitalization what was there was very minimal. Like now the businesses or the businesses which have been growing, or the new businesses which have been coming up, they are using artificial intelligence as their business models, or say they are mainly digitalizing the thing, or there are UPIs as a mode of payment which has been come into introduction, and which ideally the business is actually growing at a very fast pace. I think the regulatory front, if we go to see, is not very well adapt to it. I think it is yet to adapt. Like it's at not at the same pace as how the business is growing. So if
Right.
Indian government would want to really grow and go ahead with the business models, it is important for them to get adapt to the businesses rather than businesses adapting the regulation front, I will say. Yes. Dhananjay, could you share your thoughts?
So yeah, so I agree with you as far as how far we have digitized since last 5 years, and especially with the introduction of various payment methods, especially UPI, IMPS. These have actually made the payment space a very lucrative space for many overseas entities as well. And RBI is also deeply involved in innovating payment space for cross-border remittances on by way of allowing aggregators, by way of doing certain sandbox kind of structures to test certain payment messages. But when it comes to investment, RBI has its own reservations because of the overall macroeconomic situation of the country. You should understand India as is not fully capital account has not reached the full capital account convertibility, and this is the main factor which will always determine when RBI wants to regulate this investment space. RBI would want to know. So one of the main reasons we cannot reach, or we'll take more time to reach there, is our foreign exchange reserves, which are very dearer to RBI and mostly all the banks as well as customers. Uh, the foreign exchange reserves are to be used in a manner which is actually benefiting the country, and not making an investment or not allowing an investments from India which will otherwise go into losses. So if you ask me, from an thought process perspective, RBI is very clear. The rupee belongs to the individual in India, but foreign exchange belongs to the country. So that thought is still there, and it continues to be there before RBI wants to open this space up like other countries, so that companies or individuals can make investments without too much monitoring or too much reporting. But coming back to the change in the thought flow of RBI, though RBI want to regulate, now they want to give AD banks more power, or empower them to take certain decisions or monitor certain things. In times what we have seen, just like what has happened in FDI, for a delayed reporting as such, there is no concept of compounding. Now there is a concept of late submission fees,
Fine, please, right.
and by paying that fine, your reporting is regularized unless there is no clear breach in FEMA. As long as the overall FEMA or FDI, rather non-debt instruments rules are intact, RBI is allowing, I mean, giving or levying late submission fees, and allowing the investment to be taken on record. Something of that sort may come in near future in ODI as well, wherein we may not have to refer everything to RBI. So some things will be delegated to us, some things where we will have to initiate certain things to other regulators and seek specific approvals. That is what the way forward is. And this FEMA 120, when framed in 2000, or it is more to relevant with that uh, business
Model.
logic.
Right.
Yeah, and with draft ODI rules coming in, which was shared possibly last year. Every bank has given their inputs, and it's under basically consultation with the government of India. That's what I heard. So it is that act is going to be make made more relevant to today's business space and today's basically investment space, wherein there will be more freedom to invest, of course, with certain reporting requirements and certain regulatory restrictions. But definitely, we can see some light there on that space.
Agreed,
So
agreed. I
So
think
I think,
that's
yeah.
there will be a lot of more ease of doing business for Indian parties when it will come to the new regulations
so
in place.
yeah. So RBI wants to do that. So RBI will regulate and ADs will monitor. That is what the expectation
Yes.
is.
So I think it's good to hear for the people here that RBI is being cautious, but yet is being very liberal, and we hope to see that things change at their own pace, but hopefully in the
Yeah.
near future. So I think
Yeah.
thanks a lot Dhananjay and thanks a lot Pooja for the refreshing session we have had. I think there is a lot to cover. I think we have just scratched the surface, and the knowledge from the knowledge aspect of banking and the legal aspect, there is a lot to cover. I think the even the turnout which we have today, that even suffices that and confirms that we have a lot to cover. We would in fact want people in the audience to just let us know what topics do we want to cover, and we'll be trying to address it in our next sessions. This is the first of our many sessions, and I think going forward we'll be doing more such sessions, and it will be informative for all the people involved. It is good to know that people are interested, and we can just talking about the scratching of surface. We are now here to pick the brains of our experts, because there are a lot of queries there in the chat box there. So while it will not be very much possible to answer comprehensively on all the answers, all the questions, because it's a regulatory aspect, and again there are a lot of things involved, we'll try to give a very crisp and a brief answer on all the things. And if not, if you're not able to give that, we'll be trying to give you a direct mail reply on your mail. So we assume the first question has been already answered from for Alan. So there's another question from Sonal, to both Dhananjay and Pooja. So in case if a non-resident gifts his entire stake in the Indian wholly owned subsidiary to a resident individual, and consequently forms a step down subsidiary in India, or makes a structure prohibited in round tripping of funds, is that allowed? Gifting of shares from NR to R is allowed in general permission? That's the first question.
So so gift is allowed under ODI. That is a way of acquiring shares. But that gift, if resulting in ODI, I think it has to be reported to RBI, and
Agreed,
we
agreed.
have to seek directions from them. Uh, there is no such structure or regulation which covers if an ODI, if a resultant gift turns into an overseas investment, that has or rather direct overseas investment, that has to be reported to RBI and seek directions. And RBI may allot UN, and the necessary provisions may trigger, in my view.
Agreed. I think because the structure as such is what makes it as a round tripping, it is better if it goes through the approval route. Obviously, if it does not go through the approval route, RBI will not be able to understand about such transactions when they take place. But I think when when the investment is been transferred or nullified or as such sold off, when the proceeds come back to India, I think it will be a problem that time.
So the thumb rule here is what is not allowed directly is not also allowed indirectly. It's simple, and you cannot keep this out of RBI purview, because a disinvestment will trigger this questions, and there will be questions asked, and there will be reporting, and it will be uncomfortable situation for the company also, or the individual also, to receive such funds. So better to keep regulator informed. uh, do not go under assumption of key, but just because it is allowed, that should not result into ODI at any point in time.
So that answers the question. I think the experts say you have to observe caution here. Okay, the next question comes from Nirav. A company in the business of event management has a tech platform which allows to capture event specific data, preserve it, and allow the customer access in the future. through a subscription model. Can such company have an FDI investment through an automatic route? What are the compliances applicable?
Sorry, under FDI. So this India, the company is in India into event management, and they have a tech platform which uh, allows the subscriber to subscribe to their events and uh, what do you call process. So basically, first we should understand what is the activity code of the particular entity, and uh, there is, to my knowledge, at least it looks there is no restriction on receiving FDI into this entity. FDI, if it is not into those 5 or 6 prohibited sectors, I think it is more or less allowed. But we need to know full details before we confirm.
Pooja, your views?
I think number nine, agree. We'll have to actually like the description what has been given is very short. We'll have to get into what exactly the entity is and how does this work out. Is it a IT company or is it a event management company? Because they have a platform. So will it be classified as IT or an event management, or do they have to bifurcate the two segments into two different entities and then go ahead with the FDI? We'll have to look into it in detail. As such seems automatic route but cannot comment as such.
Yeah. So Nirav, I think we'll have to refer to your question specifically after the email and on the chat. Okay, so the next question comes from Kunal. I have a case scenario query from client said that there are two entities. A company is IP and B company is Chile. Is at Chile, South America, formed a JV company in Chile named as C. Okay, there's a little complex. There is company A, B, and C through ODI route of Bank of Baroda. Now another IP named D wants to give SBLC guarantee to JV company C in order to establish a credit line funding at Chile. Is that possible?
So company D is not an Indian party to this particular project or UIN. Firstly, secondly, it does not hold any equity investments into the overseas company C, and financial commitment can only be undertaken by the entities who have got financial equity investment into that company. So further, the guarantee regulations also prohibit such transactions. So guarantee and ODI regulations will not permit this unless the D is a party or joins to this particular UIN and invest under equity and then gives the SBLC guarantee to support credit facilities. That too, there are norms. I think prudential norms ask Indian party has to have should have a stake of more than 15%. So this has also to be read along with the prudential norms which are used by credit team whenever and such kind of foreign guarantees issued. So that those are separate set of regulations to be read with ODI guidelines.
I think it goes under approval route as Dhananjay rightly said. Because the D does not have equity investment in it. So then giving SBLC directly without equity investment will be a problem.
Yes.
So yeah, so now that is clear. We have two more questions for the interest of time here. Shubham has one short question: how to get the investment back? Can you explain that part again? And can we give loan to the JV or wholly owned subsidiary from Indian company?
Yeah.
Dhananjay, you will want to go ahead with
No,
the
you start. You start. You
yeah.
start. Not an issue.
Yes. I would like to answer the second question first. Whether they can give loan to the JV wholly owned subsidiary. The answer to that is yes. It will be counted in the financial commitment part or the 400% of the net worth limit what has been provided in the regulation right now. But loan can be given only after there is an equity investment, which is assumed because it's an JV or wholly owned subsidiary outside India. The first question was whether the investment can be bought back. Explain the part. Investment can be bought back in India. It can be done via two ways. Either you sell off the shares to someone else. That someone else can be whether located either in India or outside India, or else you close the entity over there, and once the entity is shut over there, you bring back all the funds back in India. So it's very much permissible, and that can be taken care of. And once the disinvestment, like closure or the disinvestment takes place, the filing requirement of ODI part 3 is required to be taken care of. And if it is transferred to a third party, the valuation norms also come into place, and they have to be taken care of. Dhananjay, please
Correct.
add if something has been
So
missed.
yeah, you're spot on with that. Only point is, if there is a partial disinvestment by the Indian company into its JV was, then you will have to keep some equity there. You just cannot, divest equity first and keep the loan outstanding there and
Mhm.
keep the entity alive. The loan has to be first repatriated, and then the equity has to be, sold off or bought back basis of valuation.
Right, right.
That is the important aspect here.
So we have the last question for the day from Abhishek Pal. Can any registered trust or societies in India make an ODI? Also, in the next point, I would like to know if there is separate requirements for making investment by way of exchange of shares for a foreign company.
So registered trust making an investment, I think that will go under approval route. It is not under automatic route. Again, question is, why will trust make an investment? Because trust is not formed for commercial purposes. That is one valid question I would want to ask here. Secondly, sorry, can you just repeat the last question?
Yeah, the
Uh,
next question says, is there any separate requirement for making investment by way of exchange for shares of foreign companies?
so I think Pooja has explained swap of shares was a mode of investment. That swap can be possible subject to, there should not be an FDI ODI, like the swap has to be between two different entities. That is a possible
Yeah.
way.
It has to be between two different entities. Valuation norms are to be taken care of, and whatever the regulatory requirements in both the countries, like are to be complied with. Like if it is swap of shares in India, then Indian Companies Act is applicable. The relevant act over there is to be taken care of. If
Applicable.
it is permissible over there, it's permissible here also.
Correct.
That, that's all from the Q&A we have. So I think we are right on time at 1 o'clock. I think it suffices that we have lawyers present in the house. That's why we're right on time, and we have bankers here as well. So thank you so much for the session, Pooja and Dhananjay, and people in the chat today, and people in the group and in the audience. We would like to say we will be coming up for more events such like that, and we'll be also looking for your suggestions to let us know what kind of topics would you want us to cover. Thank you, Vakilsearch, thank you, InCorp, and thank you, Dhananjay and the team DBS for organizing this event. We hope we have answered all your questions, and we'll catch up again.
Yes. Thank you so much.
Thank you.